The quiet success of China's huge dollar bond offering timed, perfectly against a U.S. freeze on microchips. It really suggests a major shift is underway. The idea that the dollar and the microchip, America's twin pillars of power, could be slipping at the same time. It could completely change how we look at global economic supremacy. Welcome back. Today we're connecting two things that seem pretty separate: high-stakes financial auctions and some pretty brutal tech bans. We want to show how they might reveal a coordinated strategic move in the global power balance. We're really analyzing the message being sent here about both the dollar and American microchips. Before we get any further, don't forget to hit that subscribe button and support Geo9. Okay, let's start with the money, because the financial data that kicked all of this off is frankly astounding. China just borrowed dollars at the exact same rates as the U.S. Treasury.
And they attracted $65 billion in bids. It's a massive figure.
But the key is who was buying, right?
Exactly. You have to look at who's buying. We are talking about sovereign wealth funds, central banks, major global insurers.
So the very institutions that historically have put all their faith and their money into U.S. debt.
The very same ones. And what's fascinating here is the stark contrast it creates. Because while Beijing was getting this cheap dollar financing, Washington was struggling to refinance $125 billion of its own debt.
Struggling.
Yeah. The dealers were demanding higher yields, and the U.S. auctions were just barely clearing.
So what you're saying is the country that issues the world's reserve currency is now paying a risk premium.
That's it, a serious risk premium.
That sounds technical, but what does that actually tell an average person about the financial health of the U.S.?
Well, it tells them that something fundamental has shifted. Normally a country pays a premium because investors are worried about default.
Right, that they won't get their money back.
But that's not the issue here. The
No.
premium investors are demanding now is a policy risk premium. They want to be compensated because Washington's political divisions make it almost impossible to predict policy, and that just injects instability into the market.
And with U.S. debt nearing, $39 trillion, that instability gets very expensive very fast.
It does. Servicing that debt is now over $1 trillion a year.
Just to cover interest payments, that's more than the entire Pentagon budget.
Exactly. And that number alone just reinforces the confidence China is projecting right now. You look at their fundamentals. China's central government debt is well below 80% of GDP. And critically, their inflation rate is hovering near 0.3%.
Okay, wait. 0.3% inflation. Is that a strength or is that a sign of weakness? Because we hear so much about deflationary pressure over there.
That's the nuance, and it really highlights their strategy. Low inflation can be a sign of slower demand, yes, but when you're issuing bonds, it projects extreme monetary discipline. It lets Beijing issue bonds aggressively at super low rates, locking in cheap long-term financing that Washington, burdened by its own inflation, just can't match. It's all about projecting control.
Here's the twist. While they're out there getting cheap dollars, Beijing's also cutting its reliance on U.S. assets. China's holdings of U.S. Treasury debt are down to $756 billion.
Which is the lowest since 2009.
A deliberate, tactical withdrawal.
Oh, absolutely. And it's measurable. Analysts estimate that for every $100 billion drop in foreign Treasury ownership, it adds about 12 basis points to U.S. borrowing costs.
So for people who don't live in the financial world, 12 basis points is 0.12%. You're saying if China sells $100 billion, it costs the U.S. government more to borrow across trillions in debt.
Precisely. It compounds, and it adds up very, very quickly. You saw the U.S. 10-year yield hit almost 5% recently.
A 17-year high.
Right. And at the same time, China's equivalent bond yield was below 2.2%. That yield gap, which always used to pull money into the U.S., is now. Well, it's telling you that big investors see equal, maybe even greater safety in Beijing's paper.
And this is about more than just shuffling money around. This is about building a whole de-dollarization architecture.
It is. After Washington froze Russian reserves in 2022, central banks everywhere, from Brazil to Saudi Arabia, had a realization.
That dollar dependency could be used as a weapon against them.
A weaponized vulnerability, exactly. And China has been quietly building the alternative plumbing for the financial system. The People's Bank of China has expanded these bilateral yuan swap lines to $580 billion across 40 countries.
Can you just break down what a yuan swap line actually lets a country do?
Sure. Think of it like a pre-approved credit card for yuan. We just saw Argentina, Pakistan, Indonesia all draw on those lines. If they need yuan to pay for Chinese goods or to stabilize their currency, they can borrow it directly from China's central bank.
So they completely bypass U.S. banks. They never even touch the SWIFT system.
Completely. They stabilize their economy, they facilitate trade, and the dollar is never involved. And then you see Beijing pricing a €2 billion bond in Paris under their new Panda Euro framework. That signals European confidence in yuan assets, regardless of any U.S. pressure.
If you're finding these insights useful, take a second to subscribe to Geo9. It really motivates me to keep sharing more research stories like this. Okay, so let's pivot to that second pillar of American power, microchips. The U.S. froze shipments of cutting-edge Nvidia chips to China, clearly trying to stifle their AI development. A major technological leverage play.
And Beijing's response was swift, and it was designed to send a very clear message of self-sufficiency. Within weeks, Huawei unveiled a rival processor, the Ascend 910B, and it's built entirely on Chinese designs and Chinese supply chains.
Okay, but this wasn't some slow, half-baked alternative.
Not at all. Reports are indicating these new processors are matching NVIDIA's previous generation A100 chips on efficiency per watt.
Matching the previous generation. I mean, that still sounds like they're behind. Why is that such a big deal for them?
Because that gap was supposed to be insurmountable. The complexity of the equipment was supposed to prevent this. So closing that gap so quickly eliminates the existential threat of being cut off. It proves they can develop high-end chips without Washington's permission. And to back it up, Beijing is planning another $40 billion in support through its state banks.
What this really means is the tech pressure Washington is applying is feeding directly back into the U.S. financial system. I mean, U.S. corporate bond defaults are already past 2020 levels. The high interest rates make refinancing a nightmare for companies that got used to cheap money.
And you're seeing that stress in the job market.
Right. 153,000 U.S. job cuts in 1 month. A lot of them in construction and tech rate-sensitive industries. These companies now face a choice: pay these crippling interest rates or just shut down.
And this reality connects directly to the cost crisis we're seeing in the U.S. AI boom. You have analysts looking at companies like OpenAI estimating they might need up to $5 trillion globally over a decade for data centers. They've called it mathematically untenable at current cash flows.
Because with Treasury yields near 5%, borrowing money for that kind of infrastructure is just prohibitively expensive.
So they're forced to seek government credit backstops. It basically turns AI development into a defense contract.
And you contrast that with China's capital and energy advantage.
That's the link. China's strategic industries get energy for around 6 cents per kilowatt hour. The U.S. average is 17 cents.
And they have a power surplus.
A power surplus, cheap energy, and Chinese AI groups can get low-interest loans from state banks, sometimes below 2%. Capital cost itself is being used as a competitive weapon, which makes their AI build-out substantially cheaper. Now think about this. All these maneuvers, financial and tech, are having a huge global effect. The dollar share of global reserves has slipped to 58%, which is a 25-year low. At the same time, China's trade surplus hit a record $1.3 trillion. And every one of those surplus dollars gives Beijing a choice.
Recycle it back into U.S. debt, which is depreciating.
Or deploy it through Chinese banks abroad. They're choosing the latter more and more, which structurally pushes up Washington's cost to borrow money.
And this all just came to a head in a real-time stress test of the dollar's credibility. On November 8th, China's $4 billion bond issue closed successfully in hours.
It attracted over $60 billion in bids.
Then the very next day, the U.S. Treasury holds its own auction, and it cleared at the highest yield since 2007 with the weakest foreign participation on record. The timing was, well, it was effective.
That pairing sent a potent message. The fundamental paradox for the U.S. Treasury now is that to defend the dollar's prestige, they have to sell more and more debt. They are feeding the very market that China is so successfully exiting. Beijing's goal seems clear. Ensure China never has to depend on the dollar again, to neutralize the very weapon the U.S. just tried to use.
So if China can now borrow dollars at the same rate as the U.S. and build rival tech ecosystems without Washington's permission, you have to ask the question, who really owns the global financial and technological system now? So what's your take on this? Share your point of view in the comments below. And if you haven't already, subscribe to Geo9 so you don't miss future insights.